Air traffic has been suspended in Dubai and parts of the Middle East. And while the focus has been on energy and shipping, there's another market quietly feeling the strain: gold. Dubai is a critical hub for global bullion flows, particularly into India, one of the world's largest consumers of gold. So what happens when material can't move? And if these disruptions persist, could we see deeper distortions across the physical market? I'm Johanna Bota, and here to break down what this means for gold and what to watch next is Rona O'Connell, Head of Market Analysis EMEA and Asia at StoneX. Hello, Rona. Welcome back.
Thank you.
So let's start with all of the air travel disruption in the Middle East. What's been the knock-on effect in the gold market?
India, mercifully, it's actually quite quiet anyway at the moment. But as you rightly say, it is one of the world's biggest. It oscillates between India and China in terms of proportional offtake. Nothing is getting out of Dubai.
Right.
So what's happening at the moment is that at StoneX, at any rate, we're still servicing clients, but obviously it's on a quieter basis. So we've got that still running fine. There's no real problem there, but everybody's working from home, of course.
Yeah.
As far as the market itself is concerned, there is, at the moment, only very early, very small signs of people looking to source material from elsewhere.
Okay.
There is reasonably good liquidity across the Far East. Switzerland should be all right too. But from Dubai into India, which is the normal conduit, no can do for the time being.
Is there any way to work around those disruptions that are happening based on the air travel?
Yes, it's going to different sources.
Okay.
We're certainly aware of a couple of inquiries in going into Singapore for loco Dubai material, ultimately loco Dubai material. So we could, well, not we as a whole, the market as a whole, can ship it in to India from an opposite direction. What you might well find, though, that it would cost a bit, because obviously it becomes a seller's market. So I'm not suggesting for a minute that people in the Far East could call the tune to any huge extent, but it might be tempting to put a couple of cents on here and there. Dubai is obviously sitting on a lot of metal, which it would normally be shipping out into India in particular, but not exclusively so. Also, they send material back to Switzerland when there's low demand for re-refining, which obviously bolsters the trade flow. At the moment, because they can't actually sell any of the material, they've got a lot there. And as of this morning, Dubai prices were sitting at a discount of between $30 and $35 to loco London.
Got it.
When it comes to premia, that would apply to alternative sources. If people are desperate for metal and they've had to go somewhere else, then you may well find that a premium would develop on the side of the seller. So as far as the underlying spot loco London price is concerned, the disruption to the market is actually irrelevant in that respect, because obviously India's very quiet. There will be pent-up demand at a later stage. There's no shadow of doubt about that. But the spot price loco London carries on regardless.
Okay.
So it rallied through 5,400 as the conflict started to escalate. It's subsequently come back, and that is also Middle Eastern driven, in the sense that the rout in the equities markets has meant that people have been selling gold in order to raise cash against potential margin calls. That's common practice, happens all the time when the equities are under pressure. So to that extent, it's had an impact, but on the underlying physical, it won't necessarily, apart from that one isolated region.
Okay, so how concerned should we be if this conflict persists?
If the conflict persists, then there will be dislocations without any shadow of a doubt. And the way one might put it would be that all bets are off.
Okay, that sounds scary. And is there anything else that we should look at outside of the Far East?
You can guess where I'm going with this one, can't you?
Tariffs?
Yes.
Okay.
Supreme Court findings last Friday night. I was on holiday, but I'm ashamed to say that I did actually watch the president's press conference, and he was one cross man, I can assure you. He says that there are two alternatives that he can use, and he's already started invoking one of them. And I've had a look at this, and they're both in the Trade Act of 1974. So the one that he's been talking about is Section 122, the other one's Section 301. Now, Section 122 allows the president scope to impose tariffs, and they actually say up to 15%, but he's only talking about 10.
Well, he wanted 15.
Maybe they've reined him in a little bit.
But then they reined him in.
Right.
He's still trying, or he was at least.
I'd missed that, thank you.
Yeah.
But there's wording in there in terms of, I can't remember exactly how it goes now, but it's very much along the lines of substantial trade imbalances and or likely to cause a depreciation in the dollar. The consensus of economists, as far as I can make out, is that those imbalances are not sufficiently strong for 4122 to count. The other one, Section 301, I think, if anything, is even clearer in terms of saying thou shalt not, because it talks about tariffs only being applicable really if it's a question of redressing a trade imbalance. Now, to me, that says bilateral, and he's talking about universal reciprocal.
Right.
So I don't think he's going to be able to implement universal reciprocal using either of those.
Okay.
He's already, or the administration, I should say, has already asked for a 90-day delay in turning the tariffs around under the Supreme Court decision. So we'll see what happens there. But as far as the impact on the gold market is concerned, that's also supportive because it's yet more uncertainty.
That's right. Rona, thank you so much for being with us today.
Great pleasure, as always.
And thank you so much to our viewers for watching. For more financial content, don't forget to like and subscribe to our channel.